Fantastic. Thank you so much. So we are looking at financial management today. This is one of the most topical issues in facility management. We all can relate. We all can relate with the real impact of facility management on the cost of the organizations that we manage or work with. And that is a huge impact, because just after salaries, which is the human resource wage bill, the second category of expenses that really make or mar organizations that we work in is real estate costs, which facility management is responsible for. And so if we as facility managers understand the profitability equation in the businesses that we are part of, it will be better for us, because we'll be able to speak the same language with the CFOs and CEOs and the C-suite. We'll be able to make proposals and act and do things in ways that brings the highest returns to the organization, not things that is going to bring the organization some harm. And sometimes we may just be thinking we are doing so well, but because we don't understand financial management, we may be making mistakes. Even in the way we recommend, even the way we make decisions might be a problem, right? So know the impact of facility management on the profitability equation. If your costs, which which you run or own a major category of, is high, profits will be depressed, profits will be low. If you manage your costs and provide good value at a reasonable or lowest practicable cost, you are going to have a lot in terms of positive results that come out of profitability, because profit is going to go up. Okay, so that's the whole essence of learning how to think financially as a facility manager. I'll have to take a quick break to check out the power in this office. I think there was a little bit of a disruption. Okay, so the big lesson for us as facility managers is that over the useful life of your building, there will be the costs that are obvious. The cost of building, the cost, what we call the value of the property. It is a big deal, but it is a tip of the iceberg of the real total cost of owning that facility. And that's why we use this iceberg analogy. Ongoing costs of running a facility throughout the entire useful life, including the energy and the labor of maintenance and everything that goes into it, and material changes and upgrades, they all can amount to more than 6 times the cost of your initial acquisition. So that's a very good lesson to learn. Because so when you talk about facility management, don't see it as something that is just transitory, something that is it's not relevant. It is the main tool. It's a system for preserving the original assets and ensuring that that asset continues to gain value over its useful life. Okay. Okay, so whether you are a facility management service provider or you work in the demand organization, which is the organization that uses facility management services, you need to understand your relationship with the people who manage the finances and accounts of the organization, because that is one sore point in our being able to deliver our results, and they are being able to, provide intelligent information to management about how the business is doing. And because we form a core spending party in some cases, we are also a core revenue source, but not too many. Not too many FMs see themselves or find themselves in positions of generating revenue for the organization. And because of that, more a predominantly expenditure department that we are, all eyes in the organization are on us. And this makes us the department to be controlled the most. And you really can't blame most organizations that have processes and systems in place that almost sounds or looks like they are put in place to gag us from being able to implement our jobs, but they are actually in place to protect us from ourselves. Facility management has a huge exposure to funds and a wide range of opportunities to be corrupt. So if you don't have process in place that protects you, which ensures that there's transparent sharing of information, that ensures that controls are in place to ensure that there are witnesses to all transactions, that ensures that certain precautions and quality measures are taken for every transaction, don't celebrate such environments, because if that happens, if you're in such an environment where they don't have such controls, then the risk is also very high for you to either be tempted to become corrupt and dip your hands in the cookie jar by doing something that are unethical, or being the subject of massive suspicion. So even if you are innocent and you are clean and cleared, there is a lot of suspicion because there are no processes to protect you. So try to enjoy and like the processes for controlling how funds are spent in the organization. You are a major spender, and you cannot be one who also opposes how that controls are put in place. And part of the reason we are learning about this is because we almost end up as adversaries with the procurement department, with the finance department, with our account department. We are almost unable to take decisions with confidence. We are virtually not leading them because we have either out of precedents in the past, out of decisions we've taken wrongly, out of not being able to think the way the CFOs and the CEOs think about money. We've created suspicion ourselves. We've put ourselves in situations where people now have to watch us. Okay? Now, to get out of that, you need to begin to work with a lot of integrity, with a lot of decision making that aligns with that of senior management. So you are never at cross purpose with your management. Finally, you have to show a lot of leadership in working with the finance and accounting team. So one of the ways you can do that, ensure that you understand the organization's mission and how the FM budget and financial decisions move the organization towards that mission. My job as a facility manager is to ensure that my organization succeeds in what it set out to do or succeed at. I don't decide what it's set out to succeed at. It's my role to understand how the organization is working towards succeeding at what it set out to succeed at, and to ensure that I create budgets that are in perfect harmony or alignment with the goals, with the activities, with the actions that will help the organization arrive at its destination. So that's basically what the FM's role is. So every time you ask yourself, what am I in conflict? Why is there a difference of opinion or understanding between me and certain people in the core business? Know it now. You are not aligning with the core business. And if you're not aligned with the core business, you are actually becoming a hindrance to the success of the core. All right? Now, rapport with the finance personnel and external customers is very key. Why? A lot of decisions, a lot of prioritizations on how funds will be allocated will be handled by the finance team. These guys do all kinds of cash flow projections. In your mind, you say, there is money. I know there is money. But you're not seeing the big picture of how all the various demands or needs for that funds will be prioritized. They see it clearly. They will often prioritize your specialty area or the work that you do if, one, they have seen previous superior value from funds expended through you. Two, a very high level of integrity. None of the funds that's expended through you is getting into your pocket. Three, a very high level of alignment with strategic objectives, which means you take decisions that help the organization move forward, not impede its progress. Then the rapport will be more. And finally, you now need to have leadership, rapport, the ability to mingle and understand them, and them understanding you becomes your responsibility. If your organization does a budget, an annual budget for how the business is going to run in the next year, do you understand your role in the budgeting process? Some FM departments don't have a role to play at all in the budgeting process. The budgets are decided, the budgets are virtually just laid out after they have been decided, and the FM is given a mandate to go and implement this budget. Now, in most cases, that happens when the FM is not very mature professionally and does not understand strategy and has not been able to contribute to strategy in the past. So senior management take that upon themselves and execute the entire budget. You wake up and you see your budget and you say, this is what I've been asked to do, this is how far I can go, and that's all you can do. In some organizations, the FM has a very broad power base in taking decisions that will help the nation move forward. All right, and that comes out of the FM being able to understand the organization's strategic objectives, create long-term plan using our strategic facility planning. You know, that course we did on strategic facility planning in the first week. That is one of the most important courses you will ever, take part in facility management. To create long-term and short-term plans that show alignment with the organization's strategic goals and mission. Once that is in place, you now have almost like a blanket approval, because you have done proactive plans, you have things laid out, you now get an approval to begin to implement those actions that you have set. With that kind of power, your budgeting is a bottom-up kind of budgeting. When you tell management, I know what you want to achieve, this is what we will do to ensure that you can arrive at that destination. You are the one creating it. You're not waiting for it to be dropped on you. You must understand where you are and where your organization is with respect to budget creation as a facility manager. Then understand fundamental accounting practices and specific practices. I am not an accountant. It's not an excuse for you not to know the different accounting codes for reporting the different kind of expenses that you undertake. It's not an excuse. You must understand. You must understand the concept of accruals. A business wants to be sure that when it declares profit for a certain period, all the expenses related to that period has been accounted for, right? And that accounting practice means that the FM should now record all the expenses that he has committed to, that he has received service for in a particular period, even though he had not paid for them. So FMs that only understand how invoices are submitted and payments are processed may struggle with the accrual accounting practice, where you have to actually document that certain expenses were incurred during a certain period, even if they have not been paid for. That's an accrual period process. Some companies have very strict funds management and accounting procedures. You have to have evidence of certain expenses. You have to have evidence of approval for those expenses. You have to have them in the journals, and ensure that each account classification is properly codified into the journal that you are filling that information into. This is not trying to make you an accountant, but you need to understand those accounting practices. Other things you need to understand are financial reports. financial records of the organization, annual reports, audited accounts. What are those terminologies? The FM should spend time understanding what those terminologies are. And that's why one of the lessons we had for the alumni invited us to last week or the week before was about taxation. How do you understand taxation? That's just one aspect of financial accounting. We must understand how to handle working funds, for example. We must understand how to handle operational funds. We must understand how to handle cashbacks. We must understand how to handle allocations, as part of financial accounting practices. Maintain clear, well understood, and documented financial handling processes. Keep accurate financial records. I know facility managers who don't even understand how their decisions affect the budget that they have. They run budget line items and sometimes are out on that line item by June or July because they are not tracking, because they are not monitoring. They are not even keeping records of their own expenses. The FM will say something like, it is procurement that bought it for us. I don't even know how much they spent on it. That is the highest level of dereliction of duty. How can procurement acquire something that you said you wanted for your work or to service or serve your customers, and you don't even care about how much it was bought for? When procurement buys it and they submit the documentation to finance and accounts, those guys load your own budget line items, and the accounting system shows that the FM has spent X, Y, Z. Why wouldn't you know such costs? Even when you are making recommendations tomorrow for replacement, for overhaul, for activation of certain warranty considerations, and so on and so forth, if you are sending a request up and you don't even know the life cycle cost of assets and services that you deliver, then there's a huge problem. So you must be on top of all financial consideration, all expense line items, not in terms of aggregate alone, but disaggregated by expense type, by income type. Compile accurate historical data for evaluating trends and forecasting. If we buy an asset, how much did it cost us? If we installed it, how much was the cost? If we operate it and then maintain it at certain intervals with certain activities and we repair it at certain points, how much are all of those costs? Do you have a way to track, monitor, and track? So if somebody comes up to say, you know what, this generator is a problematic generator, I should have data that shows what I have been doing with regards to that generator over time, till the point when such a statement or comment was made. And I can have data to back up such a comment because I have historical data. So whenever somebody is taking over your facility, if you have data or records on how certain maintenance activities are taking place over time, it's very helpful. So the person knows exactly how well these assets have been maintained. It's also helpful to ensure that the person can get a sense of life cycle, what has gone into that asset or equipment or that facility or component of the building from its inception to where it is at this point. So when you do a condition assessment and you see a level of dilapidation or you pick out certain defects, you want to tie your defect level, your cost of remediation, which is the cost of restoring it back to full functionality. You want to tie that back into how much has been spent historically. Because at the end of the day, if the cost that has been spent historically to the point where you are is already very high, it becomes a factor in thinking about whether you want to spend this new fund to restore it, or you want to go ahead and just go and do a replacement. So that is a key consideration that you get from having historical data. Trends and forecasting. What is going to happen in the future in terms of cost? It can only be done if you know what has happened in the past in terms of cost. You do a projection based on the historical data you have acquired from behind. If you're not keeping financial records right now, you cannot sensibly predict how finances and how costs will move in the future. And that's why a lot of the budgets that we have today in the industry are really not realistic budgets. They're not really answering the question, what is it that we need and how much is it going to cost us, because basically what we are doing is we are recycling the same old rule of thumb approach to dumping figures here and there without getting close to accuracy. And I dare say that when you forecast or budget, the variance from what you forecasted between that forecasted or budgeted amount and what you actually spend is a measure of your success or your performance on that activity. So in essence, it doesn't matter whether you overspend by more than 10% or you underspend by more than 10%. It is always a problem when the variance from what you set is wide. And you, without having proper historical data on how much you are spending to date, you cannot make that projection as close as possible so that your final spend will be in alignment with what you have anticipated. Your operational and capital budget, we'll talk about those in a bit. Separate them. I've seen a lot of budgets, especially for residential estates and mixed-use properties. The budget goes top deep, right? So one year the budget is this low, and the next year is that high, and then it goes up, and then it dips again. Why? Because they are dropping capital expense items into operational budget. Capital expense items are supposed to be run as a separate budget, but we bring them together so that we can relate, because if a CapEx happens, it has an impact on OpEx. If I used to spend 500,000 every month for maintaining my generator, if I replace my generator in June, for example, there should be an expectation that from July onward, my cost of maintaining generator will no longer be 500,000, it will be less. Even though I'm budgeting for them separately and account for them separately as two different budgets and two different accounts, one impacts the other. So I must read them together. But I must know the difference as a between a capital budget and an operational budget. Capital budget and operational budget, we'll talk about them as we go on in this lesson. And then your budget must be monitored so that you can do cost corrections as you go, or set budget variances. That variance is what you want to watch. So if you are not monitoring your budget on a regular basis, you are going to be notified one day that a certain line item, but your total budget has been eroded by so much. And there's nothing you can do again at that point. You look very responsible because you're only going to take go hand in cap in hand to management to seek for more funds, for them to reappropriate funds into FM, almost threatening that, or else, how FM behave sometimes when it sounds like, if you guys don't give us the money we need, this place will crash. Of course, the place will crash if you don't give the money you need, but the whole proactive process of ensuring that place cannot crash, ensuring that the resources to manage that place is well planned and well thought through, and everybody has a view to it well in advance of those funds being needed, then we cannot say the FM is doing the job properly. And then know how to discern the managerial implications of external and internal financial statement. Let's talk about financial statement. Every time a financial statement is released by the organization, it tells the health of the organization. It indicates how the organization is doing with regards to cash position. Your organization can be very rich on paper, but basic commitments that requires today's money, they don't have it. It could be a credit control issue where people are owing too much, right? It could be an investment issue where you have over-invested in things that are long-term, that are going to bring results in the long run, but as of today, your cash flow is zero. And the company can actually go bust. Very rich, but can go bust because it has a poor cash flow. As facility managers, we are always dipping into the cash that is available now. And because we're always dipping into the cash that's available now, we of all people should know when the organization has cash or when it does not have cash. And then we also need to be able to create our own projections for the kind of activities we can do at different times of the year or seasons if the organization's cash position has a cyclical or seasonal flow or flair to it. What does that mean? If I read my organization's management and financial records and statements, I can defer certain high cost activities. I can use certain second or third options as recommended options that will be low cost, that will be less of upfront investment and more of vendor applications and vendor solutions and submissions where we can benefit from before we make a payment, and so on and so forth. It shows that you understand the implication of those financial statements. And the things you recommend will now be more and more in alignment. I mean, it doesn't help an end to see a proposal from you to solve a problem that he really wants solved. He really wants it solved because it's a thorn in his flesh and the business cannot move on without solving that problem. But he doesn't have the funds. And you send a report to say, I need all this money and that's the only option I have, or else nothing. If that executive has to think through it himself and come up with an option and call you one day and say, go and execute this option. And whether it works or it doesn't work, because many of us, when we are not aligned, we will have a way of making sure it doesn't work, right? But the thing you have lost with that is that the management is now thinking for you. They are not solving their own problem. You are no longer a problem solver or someone who adds value to the management decisions or headaches anymore. That makes you completely discardable, not just dispensable. Not just dispensable. So that's all that you need to understand. Understand what those financial statements are saying. And in many cases, they can give a glimpse of where we are coming from, and they can give an insight into where we are going to. So you know how to plan your own activities and your budget to ensure you can keep staying aligned all through. One of the most important concepts in facility management is the concept of life cycle costing. The process of determining in present value terms all costs incident to the planning, design, construction, operation and maintenance, and disposition of any structure, asset, facilities, components, just name it. You analyze costs over the lifetime, entire lifetime of the asset. And you do this life cycle cost analysis well in advance of that acquisition. So what does this mean? It means that as facility manager, you don't acquire any assets, you don't take over any assets that you've not thought through and documented life cycle costing. Very helpful. And then consider how to choose between options. Like I always say, your option should always be not less than 3, right? And every time you come up with an option, the pros and cons of each one, you also have a recommendation. That recommendation will be tied to what your analysis has showed. And if you are doing life cycle cost analysis, you're not using the raw cost as it were. So if somebody says electricity costs for running a particular machinery is going to be 100,000 this year, and that machinery is going to work for 20 years, we are not going to use 100,000 for every year for that 20 years. So we can now come and say, oh, well, this option has 2 million maintenance cost. The other one that is a cheaper equipment has a 3 million maintenance cost. By using figures raw without converting them to their present value cost, you'll be making a huge mistake, a huge error in your final judgment. Because the 100,000 spent today, it is way more in value than the 100,000 to be spent next year and the year after. So it keeps getting smaller and smaller and smaller. All right. See it this way: if I was to have 100,000 by next year, how much do I need to put in the bank now this year to be able to have 100,000? Because there's interest that will be applied to that money, you can say that money has to be less than 100,000, because at the end of 1 year, the bank puts something, maybe 6%, maybe 10%, whatever the percentage, right? So in doing my analysis on future expenses or future cost outlays, I must factor in from today, because it's today I'm doing the comparison, right? From today I'm doing the comparison. I'm doing today's estimation of all the costs that if I put that money out today, it will be enough to cover all costs into the future. Because every year, any amount I did not spend, you also have an interest to fill it up. And that interest will continue until that end of that period. That's exactly how I make my calculation. So that way, I have factored in everything. And I'm not going to wake up tomorrow and realize that my estimations are not correct. Okay? Opportunity cost of changes stroke error correction at different phases of the asset development cycle. Your typical assets, whether equipment, building components, or building or campuses or massive developments, will go through your of course, there's a planning stage before you get to design, and then procurement of all the materials that will go into the construction. You do the construction, and then you commission and hand over, and facility management starts from the operations and maintenance stage, right? Now, as the asset development process is progressing, your cost-saving opportunities are dwindling. The same way, your opportunity cost of error is increasing. I've done some inspections of some, buildings around Yaba area lately, and I found some very, very, terrible design flaws. Terrible design flaws. You have created habitable spaces, so you thought, where you have allowed doors to be opened in all directions, thereby creating even if it's not marked, a walkway around, because wherever there's a door, there must automatically be a walkway, even if you wall it or not wall it, right? And so you might not make that space useless, because if any of those doors open, there's nothing you can really do in that space, especially if both of them open at the same time. So what do? It was designed, you saw it on paper, you did nothing. Now that they have finished fixing everything, it now built roof, and the doors have just been hung. You now realize that, oh, there's no space left anymore. What should you do? Oh, well, we can take off a certain wall and merge that corridor with this space. Or, well, we can, change the doors and make them reverse so that they can open the other way, making the other way useless again anyway. But in all, you are spending a lot more than what you should have spent if you had just looked at that design, did that visual inspection, and say, you know what, this space is going to be useless because these 4 doors are open into it. How much is it going to cost you in designers extra hours or bill to fix that error than to start breaking blocks? There are material choices that we make during design to estimate the bill of quantities and get a cost that's reasonable, only to finish building it and somebody says, no, this is going to give us problem. Let's change it. And what do? We start breaking again. So the opportunity cost of error correction will just keep going up. I have a friend that had a very fantastic building, nice mansion. Visits his friends abroad, comes back and says, you know what, I don't like the idea that we have walled our kitchen away from our dining area. Let's start taking off all of these walls, 2 walls, to merge spaces, because that's how a family living area should be. That's a huge cost that when it was still on design on paper would have just been a piece of cake. Erase or take a new sheet and sketch again and then merge them, and straightforward, you're done. Okay. Now look at the cost saving opportunities aspect. Again, choice of materials. You have used materials that would allow clothing to release thermal exchange as freely as possible, so that when air conditioning is on, the air conditioning is working to overdrive, just trying to cool that space, because the windows and the doors are not insulated properly and the walls are not insulated properly to allow for efficiency. So when you start complaining about energy costs later, what's happening? that opportunity to save funds and reduce that future cost could have been saved when you were still at design, when you were still at construction. You are looking at a drawing that is having split air conditioners hanging in the air outside, where there's no landing to do a servicing or maintenance on it. And you allow them to finish painting and installing. So after the first 1 year, when it's not becoming critical that we need to go and do some servicing on those outdoor units, now realize that we need scaffolding to get to the 6th floor and the 5th floor. Of course, there was scaffolding when the construction was going on, but that scaffolding is not going to stay there forever. And the reality hits later when the scaffolding has been removed and the place has been tidied up. The opportunity, the cost savings opportunity has dwindled greatly. We either have to live with the entire cost of getting a scaffold for every time you want to do a maintenance activity, or you have to raise a project to find a way to move those outdoor units to some landings or to the ground floor, thereby replacing the entire air handling units because the bigger compressor will be required to travel a distance and take cooling up to you at the 6th floor and things like that. These are opportunity, cost of error correction and cost saving opportunity that works in inverse proportion. This diagram alone, this particular graph, is enough to justify any analysis you are trying to present to management about taking action to reduce future costs, because future cost is just going to be perpetual. If you can keep future costs to the minimum, even if it's at a cost premium right now during construction of the project, then do it. You use this to make the case. Take, for example, LED lights are expensive. A unit is 10,000. Fluorescent or incandescent lights are cheaper. A unit is 5,000 or 6,000. Sounds like a 50% reduction, half of the price to buy this other one. But if you now use this as an analysis to say, if we put an LED light, it's going to consume so much in terms of current. If we put an incandescent bulb, it's going to consume so much in terms of current. This is the number of hours this particular equipment will run for on a typical day. And this is the difference between this equipment and that equipment. And as we run this facility for the nearest future, we are going to have this particular cost difference balloon, and we're going to spend it. If we finally decide in the future that we're going to change our minds and do this investment, this is what we're talking about. The opportunity cost of error correction would have gone way to the roof. For example, we may now need to evacuate places to do a renovation or remodeling. We now need to hack through walls to bring in expensive repair work, take out things from the walls and put things back in there. We may now have to take out cables and we run new ones because they can't match the capacity of what we're trying to do, and so on and so forth. There's a lot that we can now begin to project now, so that management sees that in the future, whatever you are dodging or trying to run away from now, you're going to meet it. We need to acquire. Lease versus purchase. And there's a third angle to this now. It's not just lease or purchase anymore. There is everything as a service these days. Should I rent an office? Should I buy a building? Or should I just go to a co-working hub and have my workers take hourly rates or daily rates on the site that charges for that, providing office as a service? Should I buy a generator? Should I rent one? Or should I get someone else who generates power, just sell power to me? Bottom line, ladies and gentlemen, is don't think about the means. Think about the end before you look at options of the means to that end. So you are not zeroed in on one means to an end and end up not exploring all of the other opportunities you may have. If you don't explore and you don't come up with enough options with pros and cons for each option, there's a likelihood that you will not be able to have an alignment with management thinking or management consideration at a particular time. You may not. Okay? So what we're trying to say here is ensure that you have a mentality of what is the final output before you start looking at the options. I don't need air conditioners. I need a cool environment that is comfortable for comfort cooling. I don't need generators. I don't need transformers. I need electricity to power my air conditioners and my spaces and my assets. That's what I need, right? Because I start from what I really need, the real outputs I need, I cannot ask questions that are more intelligent. How can I get power? I can buy the gen, I can fuel it, I can maintain it, or I can get someone else to give me power. So what am I saying in essence? There are multiple ways or multiple means to reach that end of getting power. What do you then consider as a facility manager? I know facility managers that will say things like, oh, well, it will be too expensive to go and rent. Instead of buying our own generator for 15 million, say renting for 1 million a month. And then I just laugh. Based on what did you decide that 1 million a month was a bad idea? What analysis did you make, did you do to arrive on that, your position that 1 million a month rental was so bad compared to 15 million outright purchase? Do you even know what your company can do with 14 million in 1 month? Do you have an idea of how much that 14 million can grow within 1 month? Because if the 14 million can grow to over 15 million at the end of 1 month, I don't ever need to spend that 15 million on buying a generator. But most FMs are not applying this level of thinking and logic. Because if I did not buy it and I pay the rent for 1 million this month, and by the next month that 1 million is made again from the 14 million that was left, that means I only rented once. That 15 million I would have spent once will ever be available to the organization to keep doing its business while I keep getting my 1 million at no extra expense. See the thinking. This is where facility managers need to advance, need to upgrade in their thinking. A vendor wants 20% more because we are not paying an advance. And you go fighting the whole management and forcing people to make sure there's an advance payment. Think again. Do I need to pay an advance? Can I use the vendor's money in the meantime? Give him 20%, which satisfies him, and make 70% or 6% more from not paying him at this time. So when you see smart, large conglomerates, companies with surplus funds telling you things like, we are going to pay you after 30 days, after 60 days, after 90 days, after 180 days. You think they are crazy? They are not. They understand that economic principle. You get richer by using other people's money. And as a facility manager, when your business, your management is trying to show you by the way they make decisions that it is better we have win-win relationships with vendors, pay them later, allow them charge more, we may dig in and become a nuisance to ourselves and the organization. Some of the considerations that you might have that the CFOs and the management might have that you may not even be aware of if you've not started thinking and analyzing strategically is tax implication. Many capital assets can be classified as investments. As investments, it is only the amortization or depreciation amount that is applied to the current year's accounting for tax purposes. So it's a small amount. So when the government wants to tax the organization, they give allowance for all of those long-term investments. So some organizations that are trying to manage their tax and tax liabilities intelligently or smartly through all forms of financial engineering, they will be happy to invest. They will be happy to buy that gen. They'll be happy to buy that compressed air machine. They'll be happy to buy large cleaning equipment. They'll be happy to buy renovate your whole building and put a new roof and so on and so forth. They'll be very happy to do all these things because it affects their tax position. But not all will shine in this category. Some are concerned about cash. How much cash do I have to run from today to tomorrow? Am I always having to borrow to run my operations? You know, many organizations are big, but they have a continuous credit line with their financial providers. So there's always money coming in on which interest has to be paid on a perpetual basis. Business is good, no problem. But for such organizations, would you think it's better for them not to borrow and pay advance if someone else can deliver and get paid later? Which means they can actually get the service, get value from it, and use that value to pay for it. Compared to taking a loan and then dishing it out. Some organizations have too much money. Their problem is, what do we do with cash? If you start hearing the organization is buying back shares, you know, shareholders have invested, and the organization now says, we have too much money, we are buying back the shares, you know, buying the shares back into the company. It's a sign that there's too much. We've given shareholders their share dividends, but we're still just giving them extra money to buy back their shares. That's a signal that we have money and you can plan. If your organization is a seasonal revenue organization where there are certain seasons money coming and certain seasons there's no money, you must also be smart enough to take decisions that help foster that kind of arrangement, where you now see where the funds are. When the funds are in, they're coming in at the same time you plan to be needing funds. And when the funds are dry, because we're in the valley at this point, you plan your activities around not having to make demand. You look like a nuisance to organizations when you're asking for money without thinking of the situation of the organization. Cash position. And then you must always think in terms of 3 alternative decisions, alternative positions. What is the life cycle cost of all alternatives? If you've not done those analyses, you cannot confidently say the gen is bad, it's time to replace the gen. You're making a mistake. The gen is bad, it's okay, we understand the gen is bad, but what do we need is power. What are the options? What are the alternative ways of getting power? That's what draws you back to planning, and you become a smart facility manager for that. The concept of cost. I know that many FMs are drawn into property management where you have to do service charge collections, you have to do cost allocation for services rendered, and so on and so forth. And some of us are, you know, in management where we are running a contract, and management expects us to, you know, account for the P&L profitability and profit and loss of such ventures, projects, or enterprise. All right, you must understand how to measure cost. What are costs that you can directly attach to a cost object, to a project, to a contract, or to an activity? These are called direct costs. They are traced specifically to an item. Indirect costs are spread over time. They are related to it, but not directly and solely associated with that item. If I have a cleaning operations, the supervisor's costs, the salary, the cleaners cost their salaries, and all the chemicals and tools and equipment and machinery that go into cleaning can all be traced directly to the cleaning. But then the managing director reads their report, comes for inspections. The HSE supervisor or coordinator comes for inspection across multiple sites, right? There are different kinds of costs that you cannot tie directly because they're either going to be shared by some means, or you use some kind of allocation approach to spread them into the cost to find the total cost. So instead of ignoring indirect cost and just using total cost as your cost, you have to have some means of allocating, sharing indirect cost. And that's why when you send a bill to a client to say, this is your cost, the total cost of FM services is 200,000 naira for the year, and it's broken into this amount for elevator, this amount for this amount for that. These are things that that individual uses with other people. So it's not really a cost that you can say, this is the whole cost. You're only finding a way to allocate that cost to that individual. And we do that all the time for indirect cost. So if I run a business or I run a department, the costs that are direct to the clients, a particular client, I can call direct costs. I know those ones. The ones that come out of overhead, the rent for my office, the official cars, the salaries of all the team in the central office that also provide support and supervision to all the other teams out there. They are indirect, and there must be some means of allocating this cost. So that's where all of those chargebacks and all of those recoveries, come into play. And like I promised you at the beginning of this class, we'll create some kind of property management model that will try to drive into issues around cost sharing and cost recovery in residential estates that this class does not currently cover. Then the concept of best value. This extends the conventional wisdom, parent value and money, and instead implies a need to continually strive for something superior at the lowest practical cost. Value is about the relationship of cost of price and quality of performance. Ideally, cost and quality should both be considerations in FM decisions. Cost should take sole priority only when financial constraints are severe and take so. In essence, cost should not override the way you think and the way you make decisions. But quality should blend in, right? Now, how do you define quality? Many of us were in the quality management class that we had. You understand, you specify using a metric. And because you specify using a metric, you gauge to what extent you are delivering to that metric. You report and you make improvements to keep closing the gap between how you're delivering and what the established metric of the customer is, right? So let me bring down best value using an illustration so you can get a sense of what we're trying to get here. If you had to buy, let me take an example of phones for staff to work with. You just go to the market and buy any phone? No. The first thing you do is to write down a specification. Item 1, I want this phone to be rugged. So it must be a solid shell case. 2, I want this phone to be a large screen, minimum 6 inches. 3, I want this phone to be Wi-Fi enabled, GSM and Wi-Fi, so that apps like WhatsApp and Telegram can be installed for communication, and apps for maintenance can be installed. I've written those 3 as my specification. And then I go to the market. I will use those 3 specifications to sort all the phones that meet those specifications. Anything that has a higher specification or an additional specification will not be considered because I'm working with minimum requirements based on specification I've written. While I was doing this, I find a particular phone that was not significantly more expensive compared to the others I've checked in the range of the specification that I went for. If I want to go for my specification, I pick the lowest one. The lowest price is what I must go for. So I must go for the cheapest phone that meets my specification. So out of 3 I shortlisted, one of them was 10,000, the other 2 were 15,000 or 11,000, whatever the amount is. So I went for the 10,000 one. And then someone comes to me to show me another phone that has all of these requirements, but it has a long battery life, 10,000 mAh battery life. And then I'm automatically tempted to ask, how much is this? It's just 10,400 naira. Just 400 naira difference with this huge battery life. Almost everybody in this class today will say, you know what? Forget the 10,000, 400 naira. Add the extra 400 naira and buy the one that has higher battery life. But that is not best value. The 400 naira is now a wasted resource. You've just wasted 400 naira. Why? If battery life that did not occur to you as a specification requirement then suddenly became relevant to you now, you should go back and restart the procurement process. You rewrite the process, the specification, to now include battery life of minimum 6,000, for example. What does that do to the other phones you have considered before? They automatically become disqualified from the consideration. It now becomes this phone that you have seen of 10,400 and any other phone that meets all four criteria, including long battery life. And because you are doing this now, there's a likelihood you will find another competing product that is 10,300 or 10,100. That is what we call best value. Your ability to drive detailed specifications to the point where you can go for the lowest or cheapest practicable cost to satisfy that specification. Your specification is your definition of quality. It's how far you can specify that you can imagine quality to. Anybody that says, oh, well, that one is not good quality because it's cheaper. You must break down quality into metrics and do a checklist to say that cheaper one, which of these metrics does it meet? Which one does it not meet? If it doesn't meet it, it's disqualified anyway. That's the whole idea of best value. So when you think about best value, think about quality in terms of specifications at the lowest practicable cost. And then this concept of deferred maintenance. Your facilities will degrade over time. We talk about a degradation curve. We talk about failure modes for every component and every machinery or every asset. Everything will die at some point. But as a facility manager, it is your job to slow down that process, ensure that your facility remains fully functional and effective throughout the period you are running it. But this is not always possible. The degradation or deterioration of your assets will be happening over time because of defects that you'll be observing on it. And as this defect increases, your assets become less and less reliable, less and less functional, less and less aesthetically pleasing, and so on and so forth. It is failing. As a facility manager, it is your job to ensure that you catalog every item of defect. That's your first job. That's your first goal. You may be able to fix every defect and keep your facility in pristine condition perpetually. But certain things may make certain defects linger. Approvals for work. The work is too small to create a work order for. It's just a small pinch of a crack on the skeleton. You can go and call a mason for that kind of work, right? Well, whatever it is, you are supposed to maintain a log, a deferred maintenance log. It's a log that catalogs all the defects that have not been fixed. You did the facility condition assessment class, which basically tells you, you do all the defect identification, you do the scoping of the problems, you do the scoping of the solution, you prioritize, you put in costs on all of them, and then you begin to execute them as projects prioritized to urgent, normal or routine, and the ones that can be deferred and done as part of CAPEX in subsequent years, right? Now, if you had that condition assessment as at the time you took over the facility, you have done some improvements, there are some residual ones, and you keep doing inspections on an ongoing basis, you use that as your starting base for your deferred maintenance log. And on a continuous basis, you add all the new defects into that deferred maintenance log. And as you keep that information updated, it becomes the accounting for the value, accounting for the quality, accounting for the level of degradation or duration of your facility. If that log becomes longer and longer and longer, we can see visibly your building is getting decrepit, is getting run down. If that log is getting shorter and shorter and shorter to zero, it means your building is getting to perfection. It's either being restored or being kept tab with. As it breaks, you fix, prevent from breaking, and so on. This deferred maintenance log becomes the tool that stands you out as a facility manager, as a professional. If your building is run down because of so many reasons, and all those reasons are in your head, you've not documented those reasons against each defect that makes for that rundown look, then you have failed as a facility manager. This is very important. Very, very important. Because many of us will go as far as doing condition assessment and then do some of the jobs in it and fire that document away. We do inspections on a regular basis, and we just do this weekly or daily report that says, oh, I requested for this repair, it was approved, this one was not approved, and you left it there. And then later, you start saying they don't approve. That's why things are like that. But you're supposed to continuously having this log. You can bring back again and again. There are times when management will have funds and they will bring funds for you in facility management, and you don't have a maintenance log that has already been prioritized according to cost and priority for each of those jobs. You will end up misappropriating those funds because critical things are not in front of you. They're supposed to have been logged and kept as a live document. One other thing we do with the deferred maintenance is calculating our facility condition index. That's what FCI means. Everything will eventually fail, but the condition of facilities will be changing along the way. The facility condition index is all your deferred maintenance and all the capital renewal that are due. Now, let me tell you the difference between these two items that are in the numerator of this equation. Your deferred maintenance are all of those little things that you have picked here and there that have gone wrong. A door handle is falling off. Oh, the tile, the skirting is falling off. This is happening, that is happening in your facility. You are picking all those in your deferred maintenance. But you have a floor, a terrazzo floor that was installed in 1969 that is due for replacement. It is still looking good. Nobody's tripping on it. But it's no longer fitting the pH that the organization wants to have for that facility. Or you have these louvered windows that are now becoming frosty. They're falling off every now and then, and you're putting back the blades. But we want to change that to a modern look and feel with aluminum profiles. Now, these are the ones I can call capital renewal. They're due for overhaul, they're due for remodeling, they're due for replacement, right? But they are functional. I'll have to add both of these costs and divide it by current replacement value, CRV, which is an equivalent of what it would take me to replace everything. In summary, your FCI can be summarized as all repair costs divided by all replace costs. I'm talking of as an asset, as a property. If I were to fix it, repair it, change components, upgrade certain things so that you can look back the way it was when it was brand new and fully functional versus scrapping it completely, disposing of completely, and starting afresh to get a new thing. That is my CRV. If I divide this out, I get a ratio. That's why it's called an index. If that ratio is less than 0.05, which is, if I convert that to percentage, 5% of the replacement value is what I need to fix things in the building. That building is in a good shape. If it gets to 10%, fair. If it gets to 30%, that building is in a poor state. You can apply this to your car. Bring 300,000 to repair it, or bring 1 million to buy a new one. You can see your car is in a poor condition. More than 31, 0.31 or 31% is gotten to critical. And if that crosses 50% mark, then that equipment or asset should be abandoned, divest from it. It doesn't make sense doing your condition assessment and getting your condition index and seeing clearly that investments in restoration and fitting up is going to be substantial compared to the cost of taking a new one and you go ahead. No. You can even apply this same FCI to new asset acquisition. Take two lands you want to buy, you're comparing between two lands. One has the foundation that has been built to a certain level. The other one is clear. While the person who is trying to sell the one that has the foundation sees it as an asset, you better first ask yourself if that foundation will be useful for the design you want to lay. If it will not, it becomes a liability because you have to have cost to tear it down. So price condition assessment is a very mathematical process. You don't just do all those defects and then take all the pictures and then create your report. Your report must lead to an FCI systems level and as a building level. So I can have an FCI for my HVAC system. I can have an FCI for my entire building. Okay. Now to the proactivity principle, the 70-30 principle. If all the work that you do as an FM are categorized, how many percentage of them will be proactive and how many percentage of them will be reactive? The more you take this metric on board and catalog and categorize your work, the more financially intelligent you have become. Because if you are tending towards more of the activities you perform as proactive, that means you have a lot of loss avoidance. You have a lot of breakdown avoidance that's happening. And you are becoming financially sound for the organization. Okay? So this is not just the Pareto principle kind of thinking. No, this is proactive versus reactive approach to work. If I'm always waiting for things to break and I fix, I'm spending a lot more. But if I'm not even measuring whether the activities I perform are generated, self-generated because of my preventive maintenance program, because of my rosters and plans, or there are calls from customers, calls from management, that I have to react to, then I need to start from knowing that metric. Because if I don't improve on that metric, I cannot improve on my cost. So to budgets, I'm sure we can all relate with budgets. Many of us will see budget as the money we need to spend, right? So the amount that will be spent over this next year, that's my budget. This is the definition of budget, a formal numerical expression of how an organization expects to operate for a defined period of time. What this definition entails or means is that you have to plan your operations and represent that plan in a numerical expression. In essence, You don't start thinking about money when doing budget. You think about your plan for delivering your services and assets. It is from that plan you codify and produce a budget. It helps to improve communication and coordination, forces management to plan, provides a basis for performance evaluation, allows for fine-tuning the strategic plan, because when you create a strategic plan, you use budget to execute 1 year at a time out of your strategic plan. So when you don't have budgets and you're not implementing using budget, you are not tying what you do on a day-to-day basis with a strategic plan, and you're not able to come back to review your progress, comparing what you have achieved against what you set out to achieve in your strategic plan. And the budget can highlight the FM contributions to the organization's core business, how you control costs, outline anticipated cost increases and decrease of the budget period. Because I mentioned before, if you're going to have an approved capital expenditure, you must be able to justify how your operations budget benefit from that. Okay. But you always hear of these assumptions, what we call a budget defense. Come and defend your budget. Almost every line item will have queries and questions. How do you come up with those numbers? What kind of considerations do you take? You just guess those numbers. What we call budget defense is called budget assumptions. My recommendation is whatever you have latched onto for creating that budget lump sum, use that justification on that line item. Don't create your budget without explanation per line item. The rates, inflation changes, salary changes, lease changes, introduction of innovation, government regulatory changes, and so on and so forth, cost changes, and so on. Whatever you are anticipating will affect your cost. You use that as an item. Of course, most of the assumptions you will make will be debatable, but it's important that you lay it out there so that your budget defense session is simplified. You've already laid the defense inside the budget. Okay, we talked about budget being used as a tool to control costs, help to outline anticipated cost increase or decrease, support the organization's core business, and quantify the impact of any capital budget on your operations. There are 3 key budget approaches. The budget could be authoritative, which means senior management produce the budget, set up the goals that we achieve, set up the amount that will be spent on each one, and tells you achieve A by using B. Participative is what we call the bottom-up approach, where you who are going to implement budget develop your costs because you've created a plan and that plan is already aligned with management's strategic objectives, because management is set up strategic objectives, and then you are trying to implement action to arrive at those objectives. So you're creating a participative budget. If management allows you to build the budget up, and then they finally make a decision on approval, then that's a bottom-up approach. Then there's a combined approach where management creates the high-level strategic objectives, caps and say we can't spend more than this, and tells you go and create a plan that helps you spend this amount in achieving this. In essence, the plan still comes from the bottom up, but management takes a decision on what will be implemented in terms of what will be applied. And then there are budget methods. These are how you build your budget. It could be incremental. We call this incremental ones the historical budget, where you take line items and cost of previous year's budgets and expenses, and then you alter and change the monies to create this year's budget. So you put an assumption that VAT has gone up by to 7.5%. Therefore, this will go up by this. You put a new figure there. Or pension, the remittances have gone up from 15% to 18%, and the company now has an additional 2.5% to bear. And then, so you are extrapolating. That's the incremental budget. Every line item will remain there, and you put a figure on every line item. But the zero-based budget insists or requires you to justify the existence of a line item. In a historical budget, you might have started drinking your potable water. For example, the treatment has been improved, WHO standard, you now have water fountains that the pipes run through and you can drink out of cold water from those chrome fountains that have been invested in. But then there are certain water dispensers that we're still bringing bottles to fill in the building. Now, in an incremental budget, you just put an amount, oh, well, we have drinking water now, so let's just put 50K there for that water. We don't really need it because we drink the normal tap water now, right? But the zero-based budget, that line item will be queried and questioned. Why do I want that line item for water? I want to solve water problem. Or there's an item of provision you provide for senior management, the executive in that particular floor, but they have moved to the new corporate headquarters. And people who are there are no longer senior executives. You keep budget for that line item. Incremental, you put something. In zero-based, you would delete that line item from. You know that every budget line item comes with a code. That code is what used to track the budget in the accounting system. So when you are doing zero-based, you take each item one by one, you delete what needs to be deleted, you add what needs to be added, and then you codify them into the accounting system. In activity-based budgets, you don't have any reference to what has happened before, whether the line items or whether the budgetary items or how much has been spent in the past. This is the kind of budget you normally will create when you are starting afresh, a new company, a new project, a new activity. You are writing down what will be achieved and how you would achieve them. And you are creating the budget from scratch. It's a plain sheet approach, activity-based. And then we talk about the budget types. That could be operating budget and your capital budget. Operating budget is simply put the budget for your day-to-day running, okay? And it normally spans 1 year, and they are normally used for things that would not outlive the budget cycle. That's your operating budget. And then you have the capital budget that includes items that once you install or acquire them, they will run for longer periods, more than the year you are budgeting. So if I create a long-term capital replacement and capital renewal plan for my facility, 20 years, 10 years, on an annual basis, I need to revisit it and capture the items that are due for next year. For example, roof is not due for replacement next year, but the windows are due for replacement next year. Those windows will now form my capital budget for next year. Of course, I have my long-term capital plan. That's not a budget. A budget is for 1 year period. And so when I create a long-term plans and I pick out the items that are due on a periodic basis, 1 year at a time, they become my capital renewal budget. All right, so that's our lesson for today. There's an assessment. Please work on it. No assignments from this class. I'm going to open the floor now for questions and comments from the class. By the way, a quick note to say that I've not had too many nominations for the class governor. I wonder why we are not pushing this. I've had class governors from previous classes. I think I've only had one lady as a class governor out of 13. So it would be nice if we can nominate some ladies in the house as class governors. If not, again, the men will take the day. But again, we need people who are passionate about the profession and are willing to commit to the welfare of the class and the welfare and the professional progress of the association we're creating, which is the alumni. Okay, it's a very powerful body already. With this, when your class graduates and joins, we would have formed the largest body of facility management managers in Africa in one single group. It will be the biggest. All right, so and we're growing this. We'll become a major force globally very soon as we grow this alumni. And so it's a very deliberate effort to ensure that the lifetime mentoring we offered you when you came on the program, that we guarantee that we provide it. And the professional exchanges that we promised you when you sign up for this program is continued. When there's anything new in FM, when there's any progress that you need to make, you need to hear it first in the alumni. And that's why we want to make a big deal out of this. So the class governor is a key factor in how we implement and execute this. So please send your nominations. I need to have all of them this night, because by tomorrow morning, 10 o'clock, when the class resumes for the live class or physical class, I'm going to make an announcement. Okay, so thank you very much. All right, so let me see who's on up for this class. Comments about the class governor, comments about anything. We still have some time. All right, yes, let's hear from Jude, please.
Yes, I need this movie oil. Movie.
Who's not muted there? Jude, please, you can speak now.
Okay, thank you, Mr. Paul, and good evening. I have a series of questions to ask, especially on quality.
Okay.
In the process of the lecture that you gave today, okay, this came to my mind because even in the office today, when we're having discussions about how to measure our key performance indices and all of that, it's one of the things that came up, and there was a big argument over it. And thankfully, it's one of the things we raised today. So I wanted to really ask, is it possible to measure quality?
Oh, yes. That's the whole essence of our quality class. Metrics. Metrics is what we use to measure quality. So you start by defining specifications using metrics. I give you a very extensive example of power supply, right? And I said, if you define metrics for power supply, the quantity of power, the quality of power in terms of power factor, the range of voltage that can be acceptable, the changeover time allowed, you create metrics. And then you begin to measure these metrics. That's your quality measurement for that power supply. If I take a cleaning, for example, I can use either SLA measures for the quality of cleaning or KPI measures for the quality of cleaning. KPIs will always be dependent on the organization's strategic goals and expectations. That's high-level quality measurement. But SLAs for cleaning, I can set the SLAs for cleaning. For example, I can use visual inspections and have a checklist for how clean a space is because I've created cleaning standards. If I see cobwebs, I see dust, that's a level 5 cleaning. If I see, if I don't see those and I see specks of stains on the tile because the place has been cleaned, but there's still stain on the tiles, for example, that are difficult to be removed, I can rate that a level 3 cleaning. So I create standards based on my experiences in my facilities, and I can use objective numbers to rate the service level of that particular service. We can do it for everything. For example, air conditioning. Air conditioning availability can be a big measure of quality, because if you're not tracking when the air conditioning system fails and how long it took to fix it back and get that space fully functional again, right? You may not be tracking quality at all. I want to ensure that one, it doesn't fail, it's always available, 100%, that's my goal, right? But for me to know whether I'm providing 100%, I need to measure. Every time it fails, boom, it has failed. What's the time now? I check, it's 6:35. I note 6:35. You put all the measures in place to fix. It was finally fixed by 10 p.m. All right, that's about 3.5 hours, right? That 3.5 hours comes out of the 24 hours of today. So my AC was not available for 100% today. What's the availability? 70, 80%, for example. That goes into the record. What am I trying to do with measuring of these metrics so that I can keep closing them? Next time, I'm going to ask myself, why did it fail? How did it fail? What did I do that took me 3.5 hours? Why couldn't I do that in 30 minutes? I cannot take insurance. You know what? This is 30 minutes, so it's not too expensive. Let me put one extra unit in the store. So in case anything fails like this, instead of having to go and start looking for oxygen to cut out the compressor and change compressor, I'll just put a new outdoor unit or a new indoor unit, and then I'll go and work this one and put it back in my store, and then I'll reduce the time of not being available so that I can be getting close to 100% as much as possible. That's quality measurement. You must decide things that you must track. These are things that help to define quality for you and your customers.
Thank you very much, Mr. Paul. I had about 3 questions, but the way you answered it, you've actually answered it, because I was going to ask you, how can quality be broken down into metrics, which you have already answered?
Yes, exactly, exactly. Thank you.
So, this is very clear now, and I'm looking forward to the other, to the class, the quality class. You know, from my background as a project manager, that's why I'm looking at the quality aspect of project management, and then the quality aspect of facility management.
You might need to revisit the video, Jude. You might need to revisit the video. We did quality last week.
Yes.
You might need to revisit the video. Go back to that video. Yes.
Okay.
Go back to that video.
All right.
Very important. Don't allow it drag too long. Go back to the videos of classes you've passed. Okay.
Okay. All right. I will do that, and then I will see call you in the background, in the offline.
Yes. Yes, definitely. There are questions you can do with it. All right. Thanks, everybody. Been a great class with you. Hope to see you again on Monday, God willing. So have a good night. Bye-bye.
Thank you, sir. Bye-bye.
Thank you.
Bye.
Thank you, sir.
Bye, sir.
Bye.
Bye-bye, Mr. Paul.
Thank you. Bye.
Thank you, sir.
Sir.
Yeah.
Hello, sir.